A single modern container terminal, one terminal, not a whole port, can cost anywhere from $500 million to several billion dollars to build. A full-scale port system, the kind that actually moves a meaningful share of a country's trade, can require tens of billions of dollars in total infrastructure investment. And yet right now, in ports all over the world, private companies are operating seaports worth exactly that much, without ever technically owning a single acre of the land underneath them. Before you buy a seaport, let me tell you something. In almost every case on Earth, you are not actually buying a seaport. You are buying the right to operate one for a fixed number of decades, from a government that never stops being the real owner underneath you. That is the entire business. And by the end of this video, you're going to understand exactly why. When you buy a seaport, in the overwhelming majority of cases worldwide, you are not purchasing land and a facility the way you'd buy a house. You are entering a concession, a long-term contract, often 25 to 50 years, sometimes longer, in which a government landlord grants a private operator the right to build, operate, and collect revenue from a port facility, while the government retains ultimate ownership of the land itself. This structure is called the landlord-port model, and it's how the vast majority of major ports on the planet actually function. There are a few different flavors of this same idea. In a build-lease-operate arrangement, the private company builds the terminal and pays the port authority an annual lease. In a build-operate-transfer deal, the private company builds and operates the facility for a fixed period, then hands the entire thing back to the government at the end of the term, infrastructure and all. Either way, the fundamental shape is the same. You're not acquiring a permanent asset. You're leasing a multi-decade income stream that eventually reverts to someone else. Here is where the numbers stop looking like anything else in this series. Because we're talking about national infrastructure, not a small business capital. At the smaller end of this world, a single new berth and terminal expansion at an existing port, the kind added to increase capacity, rather than build something from scratch, can run in the range of $100 to $200 million. The Seaport Marine Terminal expansion in Baltimore, for example, involved $105 million just to build one new 50-foot berth and its cranes, under a 50-year lease arrangement with the state. A full new mega-container terminal, the kind capable of handling next-generation ships carrying 18,000 containers or more, commonly costs around $500 million, sometimes more, built through a public-private partnership where the private operator funds construction in exchange for the multi-decade right to run it. At the very top of this ladder, a complete world-class port system, the infrastructure, the dredging, the land reclamation, the cranes, the yard equipment, the connecting rail and road networks, can require tens of billions of dollars in total capital investment across its full build-out. Here's the part that catches even seasoned investors off guard. None of those numbers are close to the finish line. A $100 million berth project still needs the equipment. The cranes alone can run tens of millions of dollars each. The technology systems, and years of construction time before a single container generates $1 of revenue. The acquisition or concession fee is just the entry ticket to a build-out that can take the better part of a decade. So you've signed your concession agreement, and technically, you now operate a seaport. Congratulations. Before a single ship docks, you have a set of problems that exist at almost no other scale of business. The first problem is that your entire investment sits on land you'll never own. Every dollar of infrastructure you build, every crane, every berth, every warehouse, is constructed on land that reverts to the government the day your concession expires. You are, in effect, making a multi-billion-dollar improvement to someone else's property, and getting paid back for it only through the revenue you can generate during your lease term. The second problem is throughput risk, and it's almost entirely outside your control. Your revenue depends on global shipping volumes, trade routes, and the decisions of shipping alliances about which ports to call at, none of which you control. A terminal built for 600,000 containers a year that only sees 400,000 isn't just underperforming. In many financial models, it's operating below the break-even capacity needed to service the debt used to build it in the first place. The third problem is that the ships themselves have been getting radically bigger, and your infrastructure has to keep up or become obsolete. Vessels carrying 24,000 containers are now sailing major trade routes. A terminal designed for an earlier generation of ships, shorter berths, shallower drafts, older cranes, can find itself unable to service the newest, most efficient vessels at all, effectively locking it out of the most valuable segment of the trade it was built to serve. The fourth problem is political and regulatory risk on a timescale most businesses never have to think about. A 50-year concession means operating under multiple governments, multiple regulatory regimes, and multiple shifts in trade policy over the life of a single deal, any of which can change the terms of the relationship you signed up for decades earlier. Let's say you've solved the big problems. Now let's talk about what it costs to actually run the thing every single year, regardless of shipping volumes. A seaport's core revenue engine is the terminal handling charge, a fee charged to shipping lines for every container lifted on or off a vessel, supplemented by storage fees for containers sitting in the yard longer than their free period. Against that revenue sits a genuinely enormous fixed cost base: crane maintenance and eventual replacement, dredging to keep berths deep enough for the newest ships, labor for a highly specialized workforce, and the interest payments on however much of that initial billion-dollar build-out was financed with debt, which for major terminal projects commonly exceeds 80% of total capital. And this is the part that quietly separates thriving terminals from struggling ones. Because so much of the cost structure is fixed regardless of volume, a terminal's entire profitability hinges on hitting a specific break-even throughput number, often measured in the hundreds of thousands of containers a year, and every container above that number contributes heavily to profit, while a terminal running meaningfully below it can post genuine losses on an asset worth $1 billion, purely because global shipping patterns shifted somewhere else. Here is where the seaport business gets genuinely interesting, because unlike almost anything else in this series, the entity you're doing business with, the government landlord, is also, in a very real sense, your business partner, your regulator, and your eventual heir, all at once. Well-run global terminal operators post EBITDA margins approaching 40%. Genuinely excellent economics for an infrastructure business. But that margin exists inside a structure where the underlying asset was never yours to fully control in the first place. The government sets or approves your rates in many jurisdictions. The government can rebid your concession to a competitor when your term ends. And the government, not you, decides whether to approve the next dredging project or berth expansion your terminal needs to stay competitive as ships keep getting bigger. Here's the number that changes everything. At the end of a 50-year concession, the entire infrastructure you spent decades building and refining, the cranes, the yard systems, the deep-water berths, reverts to the landlord, often for little or nothing beyond what's already been paid through lease payments over the life of the deal. The entire economic model of seaport ownership isn't building a permanent asset. It's extracting the maximum possible return from an asset, from the day you sign the contract, you will eventually have to hand back. There are really two types of entities that end up operating seaports, and their strategies look almost nothing alike. The first is the global terminal operator. It's massive, publicly traded port companies running dozens of terminals across many countries simultaneously, diversifying the throughput risk of any single port across a global portfolio. When one region's trade volumes dip, another region's typically offsets it, and the sheer scale gives these operators negotiating leverage with shipping lines that a single port operator could never match. The second is the single asset or regional investor, a private equity fund or infrastructure investor, concentrating capital into one port or a small regional cluster, betting heavily on that specific trade lane's long-term growth. This operator's returns can be spectacular if that region's trade volumes grow as projected, and genuinely painful if a competing port, a shift in manufacturing geography, or a new trade route quietly redirects the shipping volumes the entire investment was built around. Let's run the numbers on a mid-scale mega terminal built for $500 million under a 30-year concession, designed for 2 million containers a year of capacity. Let's look how the optimistic scenario works. For example, regional trade grows as projected, and the terminal reaches 1.8 million containers a year of throughput within 5 years of opening, comfortably above its break-even volume. At a healthy terminal handling charge and a 35% earnings before interest, taxes, depreciation, and amortization margin, the terminal generates strong, stable annual cash flow for the remainder of the concession, comfortably servicing its construction debt while still returning meaningful profit to its operator, well ahead of the concession's eventual expiration. Now let's look how the realistic scenario works. Imagine 5 years after opening, a new, larger, more modern terminal opens 200 miles away in a neighboring port, backed by a shipping alliance looking to consolidate its calls at fewer, larger facilities. Volume at your terminal stalls at 1.1 million containers a year, meaningfully below break-even. Fixed costs, debt service, and maintenance don't decrease to match, and the terminal operates at a loss for several consecutive years, while the operator negotiates with the government landlord over rate relief or infrastructure upgrades needed to compete for the business that just left. The difference between those two outcomes was never really about how well the terminal itself was built. It was about a trade route decision made by a shipping alliance in a boardroom on the other side of the world. Owning a seaport, at almost every scale that actually exists in the real world, is not owning a seaport at all. It's leasing the right to run one of the most capital-intensive businesses on Earth, on land you'll never keep, for a length of time fixed the day you sign the deal. In a business where the customers who actually decide whether you succeed, the world's shipping alliances, are making decisions you can influence but never control. The $100 million single berth expansion and the multi-billion-dollar full port build are the same business wearing different clothes. A bet that enough ships will keep choosing your berths over someone else's for long enough before the concession clock runs out and the whole thing reverts to a landlord who is always the real owner underneath you. For the operator who treats the concession as exactly what it is, a very long, very expensive lease on the right to move the world's cargo, a seaport can be one of the most durable infrastructure businesses on the planet. For the operator who forgets that the land was never truly theirs, it's an expensive way to discover that the biggest, most permanent-looking asset in this entire series was, this whole time, just a very large, very slow-moving rental.